Have you ever watched your trading profits vanish in minutes, wondering how you missed the warning signs that were right in front of you? That sickening feeling in your stomach as the market suddenly reverses against you, taking back all those gains you were just celebrating, might be the most painful experience in trading. But what if I told you there's a way to see these reversals coming before the crowd does? Today, I'm diving into one of trading's most critical skills: knowing when to step out of a position before it reverses against you. Has this ever happened to you? You ride a stock to impressive gains, feeling like a market genius, only to hold just a bit longer and watch those profits evaporate in days or even hours. This painful cycle repeats for countless traders, not because of bad luck, but because they're missing the subtle signals that professionals have learned to spot. But before we begin, please hit the like button and let me know where in the world you're watching from. Today, it's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. The legendary Jesse Livermore once said, "The market whispers before it shouts." By the time most people hear the shouting, the smart money has already left the building. What separates consistent winners from the crowd isn't catching every penny of a move. It's having the discipline to recognize when a trend has run its course and step aside before the reversal hits. Think about it. How many times have you watched a stock climb day after day, only to be shocked when it suddenly drops like a stone? That moment of surprise is exactly what we're learning to eliminate today. The signs of exhaustion are almost always there if you know what to look for. One of the most powerful indicators is volume. Remember this: prices don't move without money behind them. A healthy trend breathes with strong volume pushing it higher. But when you see prices climbing with diminishing volume, that's like a fighter throwing punches with no weight behind them. It may look the same at first glance, but the strength is gone. The big operators have already exited, leaving retail traders, possibly including you, buying from one another at the top. Stay with me until the end of this video, because what you're about to discover might completely transform how you see market movements. These aren't just theoretical concepts. They're battle-tested techniques used by the most successful traders in history to protect their capital and preserve their gains. Imagine being able to sense when a market move is exhausted before the crowd panics. Picture yourself calmly taking profits while others are still piling in, only to get trapped when the reversal comes. This skill alone could be the difference between consistent profitability and the frustrating cycle of making money only to give it all back. The market leaves footprints for those who know where to look, and those footprints often appear in the most counterintuitive places, sometimes disguised as strength when weakness is brewing beneath the surface. If you want to master the art of reading market signals like a professional, hit the subscribe button now and join our trading community. One of the most revealing signals that a transformation is happening beneath the surface comes in the form of sharp breaks. When a stock that's been climbing steadily for weeks suddenly drops with unexpected violence on high volume, the crowd often dismisses it as just a healthy correction. But this mindset trap is precisely what separates professional traders from amateurs. That first sharp break isn't random noise, it's deliberate action. It's the market's first warning shot across the bow, telling you that something fundamental has changed. The professionals who've been supporting the move are now heading for the exits. They don't announce their departure with a press release. They simply start selling, and that selling shows up as that first dramatic break in an otherwise smooth trend. I've witnessed this pattern countless times throughout my journey in the markets. A stock climbs beautifully for weeks, creating a sense of comfort and predictability. Then suddenly, without any obvious news, it drops 5% or more in a single day on volume that's double or triple the recent average. The financial media, scrambles to find a reason, attributing it to some minor news item that would normally be ignored. But the real story is written in the price action itself. The big money is leaving the building. Think about your own trading decisions. How many times have you brushed off that first violent break, convincing yourself it was meaningless noise? The hidden truth is that these breaks are rarely isolated incidents. They're typically the first visible crack in what will soon become a much larger reversal. Now, I want to go even deeper into this topic by revealing another subtle but powerful indicator, what I call tape hesitation. This is where your development as a trader really accelerates, because most people simply don't have the patience or awareness to notice these crucial signals. Near the end of a trend, before the obvious collapse that everyone can see, there's a period of hesitation. The stock seems to lose its momentum and direction. You'll notice backing and filling, aimless action stalling near the highs. It looks like the stock wants to move higher, but can't quite muster the energy to break through to new territory. This hesitation reveals a profound revelation about market behavior. Professional support is withdrawing. The strong hands that were previously absorbing all selling pressure are stepping aside. The impact of this subtle shift can't be overstated. When the professionals pull their money out of a stock, it's like removing the foundation from a building. The structure might stand for a little while longer through sheer momentum, but its fate is sealed. These behind-the-scenes movements often occur while headlines remain bullish and analysts are still upgrading the stock. The disconnect between what you hear and what the tape is telling you can be jarring at first, but learning to trust the tape, which never lies, rather than the narrative, is one of the most liberating moments in a trader's development. The next time you're in a trade that's been working beautifully, pay special attention to how it behaves near the highs. Does it move with the same conviction it had earlier in the trend? Or is it struggling, churning, wasting time and energy without making progress? That's the market telling you something important that others aren't yet hearing. If you're recognizing these patterns from your own trading experience, put "I see it now" in the comments below. I'm curious how many of you have observed these signals without fully understanding what they were telling you. What makes market psychology so fascinating is that right when you might expect a tired trend to just fade away, it often does something completely unexpected. It accelerates. This paradox represents one of the market's most deceptive illusions, what traders call the blow-off top. It's the final act in the drama, and understanding it can transform your approach to managing positions. Imagine watching a stock that's been climbing steadily for months suddenly explode upward, gaining more in 3 days than it did in the previous 3 weeks. Headlines become euphoric, social media lights up with excitement, and a powerful fear of missing out grips even the most cautious investors. Behind the scenes, though, something very different is happening. This isn't the beginning of a new phase of strength. It's the climax of the move, the final temptation before the fall. I've experienced this illusion from both sides of the trade. In my early journey, I chased these explosive rallies, convinced I was witnessing the birth of something extraordinary. The painful revelation came when these same stocks collapsed just days later, often wiping out months of gains in a week. What looked like strength was actually exhaustion, the last gasp of a trend before reversal. The hidden truth is that big operators need this final surge of enthusiasm. They can't unload their massive positions in a quiet, orderly market. They need volume and excitement. They need you and other retail traders rushing in to buy while they quietly distribute their shares. It's a carefully orchestrated transfer of risk from the strong hands to the weak. This mindset shift, learning to view extreme strength with skepticism rather than excitement, marks a crucial milestone in your development as a trader. When everyone around you is celebrating new highs and projecting even higher targets, your ability to step back and question the sustainability of the move becomes your greatest asset. Now, I want to go even deeper into this topic by exploring another critical aspect of market awareness: watching the leaders, not just the averages. Every major market move has its generals leading the charge. These are the stocks that set the tone, that move first and strongest, that capture the imagination of traders and investors alike. Their impact on market sentiment far outweighs their actual representation in the indices. Ready to take your trading to the next level? Subscribe now for more insights that the Wall Street insiders don't want you to know. What's remarkable is how often these leaders begin to falter while the broader market continues higher. This divergence isn't random, it's a powerful signal that the foundation is weakening. The generals are retreating while the foot soldiers march onward, unaware that their commanders have abandoned the field. By training yourself to monitor these key stocks independently from the market averages, you develop an almost sixth sense for when conditions are changing beneath the surface. You begin to notice subtle shifts in behavior. A leading technology stock that used to bounce sharply from every dip now struggles to recover, or a former high flyer that consistently led the market higher now lags behind on up days. These decisions about which signals to prioritize can make the difference between consistent profitability and the frustration of always being a step behind. If you've noticed how certain stocks seem to tell the story of the broader market before it becomes obvious to everyone else, drop "I watch the generals" in the comments below. The psychological journey of a market trend follows an almost predictable path of human emotion and group behavior. This awareness of sentiment cycles can give you an extraordinary edge if you learn to position yourself against the crowd rather than with it. At the beginning of a powerful move, skepticism dominates. The public doubts, analysts question, and only the most perceptive investors recognize the opportunity. This is when the professionals quietly accumulate positions. As the trend progresses and prices climb, skepticism gradually gives way to acceptance. More investors join the parade, and media coverage becomes increasingly positive. But it's the final phase of this emotional cycle that offers the most powerful insight. When acceptance transforms into euphoria, you'll notice this shift in the world around you. Suddenly, everyone is talking about the market. Your neighbor, who's never shown interest in investing, asks for stock tips. Social media feeds overflow with market commentary from people who were silent just months earlier. This perception shift represents a critical moment of truth. When the barber starts giving stock advice and the taxi driver tells you about his latest investments, it's not a sign that the trend is gaining strength. It's often a warning that the end is near. The paradox is mathematical in nature. If everyone is already bullish and invested, who's left to buy? The market needs new money to sustain advances, and when participation reaches its maximum, the fuel for higher prices simply runs out. Understanding this intuitive pattern helps you develop the rare capacity to step away when everyone else is piling in. It takes tremendous discipline to sell when the crowd is most excited, but that's precisely the moment when risk is highest and opportunity lowest. The chatter grows loudest at the very peak, right before the fall. Now, I want to go even deeper into this topic by exploring how market rhythms change as trends mature. This is where your pattern recognition abilities become truly valuable. Every sustained trend establishes a distinctive tempo, a synchronized dance between advances and consolidations. A healthy trend typically follows a predictable cadence. It pushes higher, rests briefly to digest gains, then pushes higher again in a steady rhythm. But just as a marathon runner's stride changes as fatigue sets in, a trend's rhythm alters as it approaches exhaustion. Instead of those crisp, energetic advances followed by brief, constructive consolidations, you begin to notice something different. The advances become less decisive, The consolidations stretch longer, the overall tempo slows, as if the trend itself is running out of breath. This rhythmic transformation offers a subtle yet powerful signal that most traders miss entirely. They're focused on price levels and headlines, while the market's changing heartbeat tells the real story. A stock that used to bounce sharply after two-day pullbacks now drifts sideways for a week. A trend that used to make new highs every few days now struggles to exceed previous peaks even after extended rest. These changes in tempo aren't random fluctuations. They're manifestations of shifting supply-demand dynamics as professional interest wanes. The market is speaking through its changing rhythms, telling you that its character has fundamentally altered even before that change becomes obvious in the price itself. If you've noticed these subtle rhythm changes in stocks you've traded, whether they've saved you from holding too long or you recognize them too late, type "I feel the rhythm" in the comments below. One of the most profound transformations in a trader's journey happens when they shift their perspective on stop losses. Most beginners view stops merely as safety nets, emergency exits to prevent disaster. But the masters understand that stop losses serve a much deeper purpose. They're tools of discipline that can reshape your entire trading mindset. When placed strategically, they remove emotion from the equation by forcing you to acknowledge reality rather than clinging to hope. Think about your own decision-making process when a trade moves against you. How often have you convinced yourself it's just temporary weakness, it'll bounce back, while ignoring the clear signals we've discussed? That internal dialogue isn't analysis, it's rationalization. And it's the exact narrative that has destroyed countless trading accounts throughout market history. What makes stop losses so powerful is that they compel you to respect the market's message rather than your own wishful thinking. They transform vague intentions into concrete actions. No one, not even the legendary traders of history, can consistently pick exact tops and bottoms. That's not the goal. The real objective is to recognize when probability has shifted against you and act accordingly. I've learned through painful lessons that the market doesn't care about my opinions, my analysis, or how much time I spent researching a trade. It only respects my actions. A stop loss is the physical manifestation of that respect. It's your commitment to honor what the market is actually telling you rather than what you wish it would say. Now, I want to go even deeper into this topic by exploring what might be the most crucial revelation of all. Understanding that your trading capital is not merely money, it's your army in the marketplace. Every dollar you risk is a soldier in your command, and how you deploy those soldiers determines your ultimate success or failure. When a trend shows signs of exhaustion, when all those signals we've discussed begin to appear, the wisest course isn't to fight to the bitter end. It's to pull your soldiers back, to conserve your strength for the battles that offer better odds. This strategic withdrawal isn't defeat, it's preservation. The hidden truth that separates consistent winners from the perpetually struggling majority lies in this capital preservation mindset. The market never runs out of opportunities. There's always another trend, another breakout, another sector rotation waiting around the corner. But if you've depleted your resources fighting losing battles, you'll be forced to watch from the sidelines when those prime opportunities emerge. I've witnessed this tragedy unfold countless times. Traders who capture a beautiful move, giving them a substantial profit, only to give it all back because they couldn't step aside when the evidence mounted against them. Then, when the real opportunities appear, the kind that come along perhaps once or twice a year, they lack the capital to take advantage. This pattern represents one of the most painful revelations in trading. It's not enough to know how to make money. You must also know how to keep it. The best traders aren't necessarily those who score the biggest wins. They're the ones who understand that selective engagement, trading only when the odds are heavily in their favor, is the true path to longevity in this challenging arena. If this philosophy of capital preservation resonates with your own market experiences, drop "Protecting My Army" in the comments below. Another crucial revelation that often goes unnoticed is how market volatility transforms as a trend approaches its end. During the healthy phase of an uptrend, price action tends to be relatively smooth and directional. Yes, there are pullbacks and consolidations, but they follow a predictable pattern. But watch closely what happens in the final stages. Volatility suddenly explodes in both directions. The daily ranges widen dramatically. The market whipsaws traders, making violent moves up and down that weren't characteristic earlier in the trend. This battlefield chaos isn't random. Noise. It's a profound signal that certainty has evaporated from the marketplace. When prices moved steadily higher, it reflected consensus among participants. But these wild swings tell you that consensus has shattered. The professionals are liquidating positions while the public is still buying, creating a tug-of-war that manifests as extreme volatility. I've witnessed this enlightening pattern play out countless times across different markets and time frames. A stock that had been climbing in an orderly fashion for months suddenly begins swinging 3 to 4% daily instead of its usual 1%. False breakouts appear, prices push to new highs only to reverse sharply the same day. These aren't buying opportunities, they're warning flares. The wisdom in recognizing this pattern lies in understanding what it truly represents. A trend ends not because prices are high or low in absolute terms. That's a beginner's misconception. It ends when the force behind it is spent, when the operators who drove it are satisfied with their profits, and when the crowd has fully taken the bait. Increased volatility is the market's way of telling you all three conditions are converging. Now, I want to go even deeper into this topic by examining what might be the single most powerful warning signal of all. What legendary trader Jesse Livermore called the sharp break on unusually high volume. This is quite literally the first crack in the wall, the initial structural failure in what had previously seemed like an impenetrable fortress. This revelation transformed my own journey in the markets. The pattern is unmistakable once you train your eyes to see it. After weeks or months of relatively orderly climbing, a stock suddenly drops harder and faster than at any previous point in the trend. The volume explodes to levels not seen in weeks. There's no obvious news to explain it. The financial media scrambles to find reasons, often attributing it to some minor development that would have been ignored in the past. What's happening behind the scenes is far more significant than any headline. This isn't random selling or profit-taking, it's deliberate, coordinated distribution by professional traders who have decided the move has run its course. They don't care how obvious their exit appears because they're prioritizing execution over stealth. Their goal is simple: get out while there are still willing buyers. The most enlightening aspect of this pattern is that it typically occurs when sentiment is still overwhelmingly positive. Analysts are raising targets. Social media is buzzing with enthusiasm. The public narrative hasn't caught up to what the price action is clearly telling you. The smart money is heading for the exit. If you've experienced that sinking feeling watching a position suddenly break down after a long uptrend, only to tell yourself, it's just a correction, before watching it fall much further, type "I've seen the crack" in the comments below. Understanding the distinction between distribution and accumulation might be the most illuminating revelation in your trading journey. These two phases look deceptively similar on the surface, but represent completely opposite market dynamics. Distribution is the quiet, methodical transfer of stock from the strongest hands to the weakest, from professionals who bought early to the public that arrives late. It's not theoretical, It's a tangible process that unfolds on the tape if you've trained yourself to recognize the patterns. Think of it as a behind-the-scenes exchange of risk. During accumulation, which happens after significant declines, strong operators absorb shares from discouraged sellers who've given up hope. The price action often looks choppy and directionless, but underneath, smart money is building positions. Distribution flips this dynamic entirely. It occurs after extended advances, when those same strong hands systematically unload their holdings to excited buyers who believe the move is just getting started. The psychological mastery of understanding this process comes from recognizing that the market operates on a cycle of hope and fear. The professionals exploit both emotions, buying when fear dominates and selling when hope peaks. They don't fight the crowd, they use the crowd's predictable behavior to their advantage. I've witnessed countless traders misinterpret distribution as continued strength, only to find themselves trapped in positions the professionals have already abandoned. The transfer is so subtle that without proper awareness you might miss it entirely until it's too late. Now, I want to go even deeper into this topic by examining how distribution disguises itself with the clever mask of apparent strength. This insight fundamentally transformed my own market perspective. Distribution doesn't announce itself with warning signs and flashing lights. In fact, it does the opposite. It camouflages itself behind a facade of bullish activity. During distribution phases, the tape remains busy. Trading volume is substantial, sometimes even increasing. Headlines remain optimistic. Analysts continue upgrading price targets. Your broker still recommends buying. On the surface, everything appears healthy. But if you look beyond appearances to the actual quality of the price action, a different narrative emerges. The revelations lie in the subtle imbalances. Volume surges on up days, yet the price gains are minimal compared to earlier in the trend. Rallies that previously shot higher with ease now appear labored, struggling to make progress despite heavy buying. Pullbacks, which were previously shallow and brief, now cut deeper and recover more slowly. These discrepancies between effort and result tell the real story. The tide has silently shifted. What makes this pattern so deceptive is that it's designed to maintain your comfort and confidence while the professionals execute their exit strategy. They don't want panic while they're selling. They want calm. They want the narrative to remain positive while they're distributing their shares to eager buyers. By the time the public narrative catches up to reality, the smart money has already moved on. This awareness represents a fundamental mindset shift in how you interpret market action. Instead of being seduced by surface appearances and public narratives, you learn to judge the market by its actual behavior, by how it responds to buying and selling pressure, by the relationship between volume and price progress, by the quality rather than the quantity of movement. If you've noticed this pattern of apparent strength, masking distribution in your own trading experience, type "I see the disguise" in the comments below. One of the most profound insights in market navigation comes from watching the leaders. Not just any stocks, but the specific ones that have been at the forefront of the entire move. These market generals hold exceptional significance beyond their individual price action. They function as early warning systems for the broader market, providing revelations about underlying conditions that most traders completely miss. When a stock has been leading a sector higher for months, commanding attention and respect, its behavior pattern offers a window into institutional thinking. These leaders aren't random. They're where the professionals concentrate their firepower. They're the stocks that attract the smartest money, the biggest positions, and consequently, they're the first places where distribution begins. The enlightenment comes when you recognize that a stalling leader isn't just telling a story about one company, it's signaling danger for the entire market ecosystem. I've witnessed this pattern repeatedly throughout market cycles. A leading technology stock that had been consistently outperforming suddenly begins to churn sideways with heavy volume but minimal progress. Meanwhile, the broader market continues higher, often led by secondary names that haven't previously been in the spotlight. This divergence isn't coincidental, it's intentional. The professionals begin their distribution in the stocks they accumulated first and hold the largest positions in. They can't exit everything simultaneously without crashing the market, so they prioritize. They exit the leaders while allowing the laggards to continue higher, maintaining the illusion of market strength. The transformation in your trading results comes when you develop the discipline to heed these warning signs rather than dismissing them as isolated incidents. The stalled leader is like the canary in the coal mine. It's telling you something has fundamentally changed, even while most market participants remain oblivious. Now, I want to go even deeper into this topic by examining what might be the most deceptive pattern of all, the infamous blow-off top. This final act in the market drama represents the ultimate trap precisely because it appears to be the opposite of what it actually is. The paradox of the blow-off top is that it looks like the moment of greatest strength. Prices suddenly accelerate dramatically, often gaining more in days than they did in weeks previously. Volume explodes, media coverage reaches fever pitch. Social platforms light up with excitement. Every technical indicator screams strong buy. Yet behind this facade of extraordinary power lies an uncomfortable truth. This is not the beginning of a new phase, but the climactic end of the existing one. The journey to understanding this counterintuitive pattern requires you to think like the professionals rather than the public. Big operators who accumulated positions early in the trend face a fundamental challenge. How do they exit massive positions without crashing the price? The answer is they need extraordinary volume and enthusiasm. They need a buying frenzy. The blow-off top provides exactly that environment. What makes this pattern so dangerous is its psychological grip. It preys on one of the most powerful human emotions, the fear of missing out. As prices rocket higher day after day, breaking through all resistance, even skeptical observers begin to doubt their caution. Maybe this time it's different, they think. Maybe I've been wrong all along. This mental capitulation is exactly what the professionals are waiting for. If you've ever watched a stock explode higher in the final days of a long trend, only to collapse just as violently. Afterward, type, "I survived the blow-off," in the comments below. As we've journeyed through these revealing patterns together, I hope you've started to see the markets through a different lens. What once looked like random price action now reveals itself as a carefully orchestrated dance between the professionals and the public. These signals aren't theoretical. They're written clearly on the tape for anyone who's trained their eyes to see them. The most powerful transformation in trading doesn't come from complex indicators or sophisticated algorithms. It comes from this fundamental shift in perception, from reacting to what's happening to anticipating what's about to happen, from following the crowd to following the footprints of those who consistently profit. Remember, the market doesn't care about our opinions or our feelings. It only respects our actions. And those actions should be guided by what we observe, not what we hope for. The professionals aren't smarter than you. They simply understand these patterns and respect what the market is telling them, rather than fighting against it. If this perspective has given you a new way to look at your charts, I'd love to hear from you. Drop "I see the footprints now" in the comments if something in this video connected with your own trading experience. And if you found value in these insights, hit that like button. It helps tremendously with getting this message to other traders who might be struggling with the same challenges. For those of you who are serious about elevating your trading, make sure you're subscribed to the channel. We dive deep into these professional approaches to reading the market's true signals, not just the noise that most retail traders focus on. There's a video right here that complements this topic perfectly, exploring how to identify the beginning stages of these powerful trends, the flip side of what we've discussed today. Click and continue with me over there to complete your understanding of the full market cycle. I'll see you in the next one.